Price breaks lower, but the trade does not begin at the breakdown. It begins at the failed hold above. That matters. May 14th Asia session forms below the lower boundary of May 6th U.S. session box. It does not form an open space. It forms under pressure. It forms compressed. It forms overlapped. It forms where older U.S. memory still sits above the market. You feel that immediately. Price is already underneath old structure. So buyers do not have freedom. They do not have clean air. They have to reclaim space fast. They have to push back into memory. They have to stay there. If they cannot do that, the lower side remains heavy. That is the condition from the start. Now watch the behavior. May 14th Asia session first forms below the lower boundary of May 6th U.S. session box. That already tells you something. The market is not building from strength. It is surviving underweight. Then price drops. It breaks below the upper boundary of May 12th U.S. session box. That is not just a small move. That is a structural leak. A prior upper boundary that once acted as support no longer holds cleanly. Price goes through it. Then price continues and tests the upper boundary of May 13th U.S. session box. That test matters, because once price breaks a prior support layer, the next question is simple. Can it come back above? Can it stay? Can it rebuild? If it cannot, then the downside remains structured. And that is exactly why the short is not emotional. It is not red candle equals sell. It is not price looks weak so chase it. The short comes from position. The short comes from failed reclaim. The short comes from the market staying below important prior memory. Now mark the trade. Short entry line. The upper boundary of May 14th Asia session box. Stop loss line. The midpoint of May 6th U.S. session box. Take profit line. The upper boundary of May 12th U.S. session box. Then the trail begins. First, trailing target. The upper boundary of May 13th U.S. session box. Second, trailing target. The lower boundary of May 14th U.S. session box. Third, trailing target. The lower boundary of May 4th U.S. session box. Risk-reward ratio, 6.18. That is large. But the ratio is not large because of fantasy. It is large because the entry is near a meaningful failure point, and the stop is placed where the idea actually breaks. That is the key. Why use the upper boundary of May 14th Asia session box as the short entry? Because that is the closest structural ceiling inside the session that continues to show failure. If price returns to that upper boundary and cannot reclaim above it with distance, the market tells you the bounce is weak. The short belongs there, not lower, not after panic, not after the move is already extended. The better short is where recovery fails. That is where risk becomes measurable. Now the stop. Why use the midpoint of May 6th U.S. session box? Because that midpoint belongs to a larger prior memory zone. If price climbs all the way back there, then the market has reclaimed too much of the older U.S. structure. At that point, the idea that price is trapped under pressure weakens. The short loses its edge. The market is no longer only reacting under May 14th Asia memory. It is reclaiming deeper historical space. That is why the stop must live there. Could an aggressive trader use a tighter stop? Yes. Aggressive traders often do that. They tighten the stop. Then they increase the size, because the stop distance is smaller. And yes, sometimes price never touches the tighter stop. Sometimes the aggressive version works beautifully. But that is not free. A tight stop also means normal noise can remove you before the trade actually pays. That is the trade-off. A conservative trader does the opposite. The stop is not too tight. The size is smaller because the stop distance is wider. That can feel slower, but it reduces the chance that normal reaction destroys the position before the target arrives. That matters more than people admit. Many traders do not lose because their idea was wrong. They lose because the stop was too proud, too clean, too thin, too impatient. So the real choice is not bravery. It is tolerance for noise. Now, the first target. Why use the upper boundary of May 12th U.S. session box? Because once price drops from the failed recovery, that prior boundary becomes the first realistic place where reaction can appear. The market already showed memory there, so it is not random. You want the first target at a place where the market might answer back. That is how structure pays. Not by guessing the bottom, by respecting where price can hesitate. Then comes trailing. The first trail goes to the upper boundary of May 13th U.S. session box. Why? Because once the first target pays, the next nearby structural memory below becomes the next decision point. Price must earn that distance. The trail is not moved because you want more money. The trail is moved because price has already given proof. Then the second trail goes to the lower boundary of May 14th Asia session box. That is important. Now price is not only moving down from the failed reclaim, it is fully rotating through the Asia structure itself. That means the entire session has turned into distribution. The market is no longer just testing weakness. It is living in weakness. That is a stronger condition. Then the third trail goes to the lower boundary of May 4th U.S. session box. That is deeper memory. That is where the move reaches beyond local session structure, into older support territory. By then, the trade has already become heavy. The market has already paid. So the question is no longer entry. The question becomes protection. And this is where many traders break themselves. They move the target, but they do not move the stop. That is not trailing. That is greed. A proper trail protects earned distance. If the target moves, the stop must move with it, but not too tightly. Too tight, and a normal bounce taps you out. Then the trail makes less than the original fixed target. That is failure disguised as discipline. Too loose, and the trail protects nothing. That is hope disguised as patience. So the stop must follow structure, not emotion, not the last candle, not the P&L number. Structure. Now, a practical rule. If you are going to trail, the trail interval should usually be at least 0.5 in risk-reward units. That keeps the trail meaningful. Too small, and you are reacting to noise. Too large, and you are giving back too much. The market must earn the next move. That is the principle. Now, partial profit. A conservative trader can take 60% at the first trail and leave 40% for continuation. That works when the first move already reaches meaningful pressure, and you want to protect realized gain. An aggressive trader can reverse that. 40% first, 60% left open. That works only if price keeps distance and reactions stay shallow. If the trade extends again and a second layer of trailing appears, a conservative trader can scale out 50%, then 30%, then 20%. A middle ground trader can use 25%, then 50%, then 25%. An aggressive trader can hold harder, 20%, then 30%, then 50%. But none of those percentages rescue weak structure. They only organize strong structure. The real edge is earlier. The edge is that May 14th Asia forms compressed below May 6th U.S. lower memory. The edge is that price breaks below May 12th U.S. upper memory. The edge is that the bounce cannot reclaim enough space. That is why the short works. Not because the candles are red. Not because the ratio looks beautiful. The lower side stays heavy. Recovery fails. The entry comes at the upper edge of May 14th Asia. The stop sits at the midpoint of May 6th U.S. The first target pays at the upper boundary of May 12th U.S. Then the trail walks lower, first to the upper boundary of May 13th U.S., then to the lower boundary of May 14th Asia, then to the lower boundary of May 4th U.S. That is the sequence. That is the logic. That is why the short pays. Price explodes wider, but the wider it gets, the worse the fresh entry becomes. That matters. May 15th U.S. session does not form like a normal session. Its range is too large. Its reach is too wide. It expands by more than 2 or 3 times the range of recent ordinary sessions. You feel it immediately. The chart becomes loud. The candles stretch. Old session boxes disappear inside the new one. That changes the trade. May 15th U.S. session forms while swallowing several older U.S. session memory boxes at once. May 13th U.S. session box. May 14th U.S. session box. May 4th U.S. session box. And more. This is not a clean single memory session. This is layered memory packed into one oversized structure. That is dangerous. Because now a trader is not dealing with one simple reaction zone. A trader is dealing with several old zones being consumed together. That creates confusion. That creates false breaks. That creates late temptation. Then price rises. It tests the midpoint of May 15th U.S. session box. And that test can look attractive. The bounce is visible. The distance from the low is real. The market looks alive. So a trader begins to think, maybe the long is here. Maybe the flush is over. Maybe this is the reversal. But this is exactly where execution must slow down. Because the setup is not only about direction, it is about quality. Now mark the idea first. Long entry line. The lower boundary of May 5th U.S. session box. Stop loss line. The upper boundary of April 27th U.S. session box. Take profit line. The midpoint of May 15th U.S. session box. Risk-reward ratio, 2.45. At first glance, that may look tradable. The market flushed hard. The market touched lower memory. Then it bounced. The midpoint became reachable. So why does the trade still feel wrong? Because context kills it. This is the final session of the week. That is the first problem. If you want safe trading, if you want a comfortable weekend, the last session of the week is often the session to skip. Not always, but often. And especially here, because this is not only the final session, this is the final session with abnormal range. That is a different level of danger. The session is too wide. It contains too much older memory. It expands through several prior U.S. boxes at once. That means the chart can move a lot without becoming clean. It can travel far without becoming easy. It can look dramatic without becoming tradable. That is the trap. A trader sees movement and mistakes it for opportunity. But movement is not opportunity. Clean structure is opportunity. And May 15th U.S. does not give clean structure. It gives expansion. It gives engulfing behavior. It gives overlapping memory. It gives the end of the week. All of that together makes Restraint the better trade. Could an aggressive trader still try the long? Yes. The long can be mapped. Entry at the lower boundary of May 5th U.S. session box. Stop at the upper boundary of April 27th U.S. session box. Target at the midpoint of May 15th U.S. session box. That gives 2.45. So the math exists. But the best trade is not decided by math alone. The best trade is decided by execution quality. And the quality here is weak. Why? Because too many prior structures are being absorbed by one oversized session. That means price can jump, reverse, spike, and rotate without giving orderly management. The trade may work, but working once is not the standard. Repeatability is the standard. And this is not repeatable enough. The other problem is timing. It is the last session. There is no clean runway left. You may enter well and still not get the type of management window that this method wants. This method needs time after entry. Time to react. Time to hold. Time to trail. Time to reduce. Time to protect. If the session ends soon, the method loses its space. That weakens the trade, even if the chart still moves. Now think about the emotional side. After a large flush, a trader wants to be the hero. Buy the panic. Catch the rebound. Leave for the weekend feeling smart. That emotion is dangerous, because final session rebounds can seduce. They can print a beautiful recovery candle. They can travel to the midpoint. They can look correct. Then they can leave you trapped inside a weekend with unfinished structure. That is not comfort. That is not clean execution. That is unnecessary exposure. So the better decision is simple. Do not enter. That is the best trading here. No trade is not empty. No trade is a decision. No trade protects the account. No trade protects the method. No trade protects the weekend. That matters more than people think, especially when the session is abnormal, especially when the range is too large, especially when several older U.S. session boxes are swallowed together. Now let's make the logic even sharper. Why is the long not clean, even though price bounces from lower memory? Because the bounce lives inside a giant session that already absorbed too much structure. The market is not bouncing in a tidy box. It is bouncing inside a monster box. That changes everything. The bigger the box, the harder the control. The more prior memory inside it, the less clear each reaction becomes. You do not want to open new one-hour positions inside that kind of noise, especially at the end of the week. Now look at the alternative. What if price falls again? Could a short appear? In theory, maybe. But even that is not ideal, because the same abnormal range problem remains. The same overlapping memory problem remains. The same final session problem remains. So the message is not take the opposite side. The message is step back. That is harder to do, but it is the right move. Now return once more to trader type. Aggressive traders like tighter stops. They reduce stop distance. Then they increase size. Sometimes that works. Sometimes it creates beautiful entries. But in an abnormal final session, tight stops become even more fragile. Noise expands. Fake moves grow. Wicks become cruel. So the aggressive advantage shrinks. For conservative traders, the message is even clearer. Do not force it. If the structure is not comfortable, the answer is already no. And yes, in theory, a wider stop with smaller size can survive more noise. That is true, but that still does not fix the bigger issue. The bigger issue is not only stop placement, it is session quality. When session quality is poor, better stop engineering does not create a clean trade. It only makes a messy trade slightly less messy. That is not enough. So here is the final read. May 15th U.S. session forms. With unusual range. It engulfs several prior U.S. session boxes at the same time. Then price rises and tests the session midpoint. A possible long can be drawn from the lower boundary of May 5th U.S. session box toward the midpoint of May 15th U.S. The ratio shows 2.45, but the final session of the week, combined with extreme range and multi-box engulfing behavior, removes the quality. That is why the best trade is not entering, not the long, not a fresh short, not a heroic reversal, nothing. The best trade is restraint. That is real execution. Sometimes the chart gives a beautiful entry. Sometimes the chart gives a beautiful skip. This one gives the skip. And that is why the week ends well, only if the trader stops, when the structure stops being clean.